Do you want to make your money work harder for you? Do you dream about a comfortable retirement, buying a new house, or maybe just growing your wealth, but don't know where to start? Well, you've come to the right place. Welcome back to our channel. And if you're new here, consider subscribing because today, we're unlocking the secrets of an investment tool that millions of people use to create wealth. We're diving into the world of mutual funds. And it's not just a tool for the financial elite, but a magic wand that you can use to build your pathway to financial freedom. So sit back, grab a notebook, and let's get started. It's time to unveil the magic of mutual funds. Mutual funds, in simple terms, are a pool of money from several investors managed by a professional fund manager. This manager invests the money in a diverse portfolio of stocks, bonds, and other assets. The goal is to generate income or grow capital for the fund's investors. Mutual funds can offer a high return potential, especially over the long term. It's important to remember, though, that all investments carry some level of risk, and past performance is not indicative of future results. Mutual funds are investment vehicles that pool together money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other types of assets. Each investor in the mutual fund owns shares, which represent a part of these holdings. Here's a simplified breakdown of how mutual funds work. Investor contributions. Investors buy shares in a mutual fund. Each share represents an investor's part of ownership in the fund and the income it generates. Portfolio management. The mutual fund is managed by professionals, known as fund managers. These managers invest the fund's capital to produce capital gains or income for the fund's investors. They do this based on the fund's stated investment objectives. Diversification. Mutual funds typically invest in a wide variety of assets. This diversification reduces the risk of a major loss that could arise from investing all money in a single security. Profits or losses. The success of a mutual fund depends on the performance of the securities it decides to buy. When the fund makes a profit from its investments, it passes on the profits to its investors in the form of dividends. If the securities the fund owns decrease in price, the fund will incur a loss, and its share price will decrease. Selling shares. When you're ready to sell your shares, the mutual fund will buy them back. The price at which you sell your shares is determined by the fund's net asset value, which is the total value of the securities in the portfolio minus any liabilities, divided by the number of outstanding shares. The NAV is calculated at the end of each trading day. Expense ratio. Mutual funds charge fees, often referred to as the expense ratio, which includes administrative costs, manager salaries, and other expenses. This ratio is expressed as a percentage of the fund's average net assets per year. These fees are important to consider as they directly impact the returns of the fund. Types of funds. There are various types of mutual funds to choose from, such as equity funds, investing in stocks, fixed income funds, index funds, aiming to track specific market indexes, balanced or hybrid funds, mix of stocks and bonds, and money market funds, investing in highly liquid, short-term instruments. The choice depends on the investor's financial goals, risk tolerance, and investment horizon. Why you should invest in mutual funds. There are several reasons why mutual funds can be an effective investment tool for you. First, they provide diversification. As they say, never put all your eggs in one basket. Mutual funds help spread your investment across a variety of assets, reducing the risk of loss. Secondly, mutual funds are professionally managed. Unless you're a financial guru yourself, understanding market trends and making investment decisions can be daunting. Mutual funds eliminate that stress. Which mutual funds you should choose? Mutual funds come in various types, each with its own risk and reward potential. There are equity funds, which primarily invest in stocks. Debt funds invest in fixed income securities, like bonds, and are generally less risky than equity funds. Balanced or hybrid funds invest in both stocks and bonds, aiming to strike a balance between risk and return. Your choice of mutual fund should align with your financial goals, risk tolerance, and investment horizon. Remember, There is no one-size-fits-all solution. Now, you might be wondering, how do I buy mutual funds? It's pretty simple. You can buy mutual funds directly from a mutual fund company, a bank, or a brokerage firm. You can also buy them online, which has become an increasingly popular method due to its convenience. So, there you have it. Mutual funds can be a powerful tool to help grow your wealth and achieve financial freedom. They offer diversification, professional management, and a range of types to suit your individual needs and goals. Always do your due diligence and, if needed, consult with a financial advisor to make the most informed decision. Remember, the magic of mutual funds lies not in quick profits, but in patience and consistency. That's the pathway to financial freedom. If you found this video helpful, please like, subscribe, and hit the bell icon. Don't forget to subscribe for more financial insights. Until next time, happy investing.